Hey, well, with higher mortgage interest rates, fewer people are doing refinancings. In fact, you even learn about mortgage companies making layoffs. Are interest rates going to come back down? When you lock in your mortgage interest rate, how long can you keep that lock for before you're penalized? I'm going to talk about those questions and more with President of Ridge Lending Group, Caeli Ridge. Also, she tells us about something called the AllInOne loan, where you get flexibility and you can even get some interest rate savings. Enjoy this chat between Caeli and I about the state of the mortgage market today. I'd like to welcome in Caeli Ridge. She runs Ridge Lending Group. They lend for investment property in almost every U.S. state, and they've now funded over 45,000 properties. They're real estate investors themselves there, and what they really do is they get in there and they structure your current and your subsequent loans correctly for you. So it's really about this long-term planning and vision for real estate investors. Welcome back to GRE, President and CEO, Caeli Ridge.
Keith, thank you. So good to see you. Thank you for having me. I always love being here with you and your listeners.
Yeah, it's so good to have you back. And so much has changed since we last had you here. Noticeably, we have higher interest rates. Now, prior to this, we had higher prices, and higher prices oftentimes want to make savvy investors do something like a cash out refinance and get a hold of that equity and maybe redeploy it, what I often call equity harvesting. But now with higher interest rates, perhaps some of that refinance appetite has gone away. For example, you often see media reports of some mortgage companies laying people off with this decreased appetite for refinancing. So in the midst of these higher mortgage interest rates with the refinance business probably going away, just what's really going on in there at Ridge, Caeli?
So we're actually not seeing too much of a decline for our investors, right? Investors, regardless of the rate, oftentimes will continue to harvest that equity because borrowed funds are non-taxable. The return on whatever they're borrowing relates to whatever that new return is, counterbalancing the increased payment. And I might just go back just a little bit. I think you and I talked about this last time we were together. Interest rates are funny, and people tend to have short memories related to interest rates. So 2019, we're probably right around where we were then, right? Fast forward about 3 years. So rates aren't, well, yes, absolutely. They're higher than what we've kind of been a little spoiled with over the last couple of years. They're back where they were, 18, 19. So for our perspective, while maybe there's a little bit of a decline, I really haven't noticed all that much. Investors are still getting at that equity and out there deploying it for more acquisition.
Now, I want to ask you what you think about rates coming back down. And this is kind of like, being able to predict the future with a crystal ball. It's a lot like asking what the S&P 500 is going to do tomorrow. So really, why don't I frame it in a way is, what would it take for rates to come back down in your mind?
There's so many variables that can dictate an answer to that question, and some of them are subjective. I would tell you that currently the two things that I see are most prominent that would create that yield would be one, the continued war in Ukraine. A lot of times, historically speaking, significant volatility to the stock market, and war is almost at the very top of that list of what can create that, will create a space where investors will flee from the volatility of the stock market and run into the safe haven of the mortgage bonds. When that happens, we see interest rates improve. Now, that has not transpired yet. I've been kind of on the sidelines waiting for this. I think that the stock markets believe that this might be short-lived, the war over there. And then in some cases I'm hearing and reading, maybe that isn't the case. So that could be one thing. And then the other thing, obviously, recession. A lot of news outlets, everyone's reporting that we're headed that direction. If and when we get there, some people are saying we're in it now. That also can tamper rising interest rates. But the Fed has been very clear that they're going to continue to help with inflation, continue to raise that Fed fund rate, which might be useful just to comment for your listeners. The Fed fund rate is the daily trading rate between banks, intra-trading between banks. It's not the same as the long-term rate. While they're connected, they are totally different things.
Right. Long-term mortgage rates being more closely tied to that yield on the 10-year T-note. And when it comes to the rate of interest rates, you gave us some context earlier about 2019. Of course, when we look at a longer term history, Freddie Mac will tell us over the last 50 years that the average rate has been something like 7.8%, still substantially higher than it is today. But of course, we do need to keep in mind that we are substantially higher now than we are in January of 2021, when mortgage interest rates reached all-time lows. all-time lows. But in there, knowing that you serve investors, you actually have a product that helps investors, no matter what their interest rate is, reduce the amount of interest that they pay with an all-in-one loan. And that's something that we haven't talked about recently, Caeli. And if I can, when it comes to an all-in-one loan, I think it gives you some flexibility. It's not quite like an interest-only loan. Oftentimes, you can describe an all-in-one loan as a first lien HELOC, a first lien home equity line of credit. So for those that aren't familiar with an all-in-one loan, tell us about it.
You bet. So I'm going to give you guys high-level stuff because this can get pretty technical. But you're right, an all-in-one. The reason it's called all-in-one is it doubles as both a mortgage in the form of a first lien HELOC and your checking and savings account. We've combined a mortgage and a checking and savings where simply your depository income is used to drive down a principal balance, saving the amount of interest that can accrue. Because in any HELOC, interest is accrued daily based on that day's principal balance and that month's fully indexed rate. So the lower the balance, the less interest can accrue. So as you're using this as your checking or savings account, if let's just say, I like to give examples. Let's say you have a balance of $100,000 and you have income of $10,000. And for this example, we'll say that you get your $10,000 on the first day of the month. You're going to deposit that into your checking account. Nothing changes about your banking features whatsoever, totally the same as you have today. So for as long as you can leave that $10,000 in against the $100,000, making it $90,000, for as many days of a 30-day billing cycle as possible, the interest accrual will be that much less. There's a compounding effect that's at work here. The second compounding effect is going to be your monthly savings, your discretionary income. Let's use it further to take this example. Let's say 10% of your $10,000 a month is what you're saving on average a month. So that $10,000 stays in there. You have full access to it 24/7, just like you would otherwise. And on the second month, your starting balance is $99,000. So when you put in your $10,000, we're down at $89,000 for, say, 29 days out of a 30-day billing cycle. What a lot of investors will do is they're going to use a credit card to pay all their monthly expenses. And I mean down to a stick of gum. Food, gas, utilities, cell phone, mortgage payments, all go on this credit card. And leaving your 10 grand in there. Before the credit card accrues any interest, you simply go online to your online bill pay off the credit card, and rinse and repeat every day, or every month rather. Well, day and month. So it's a very unique model in which it kind of creates a scenario where you become your own bank. You're controlling the amount of interest that can accrue on a daily basis based on depository income from all sources. It'll greatly reduce the amount of interest that you'll pay. But I think more than that, the interest savings on this is fantastic. I really think that the all-in-one is uniquely qualified to really support investors because you've got this line of credit for 30 years that you can access, pay it down, draw it out, pay it down, draw it out for your down payments. You could do the BRRRR method on this thing, and you're using the gross rents along the while with your depository income, right? All of that should be used to really continue to save interest and have this line of credit. No pre-qualification. You're not paying closing costs again unnecessarily, right? So it's kind of a unique model and one that's not as well known. It's a little bit more sophisticated, so it takes a minute for people to wrap their heads around it. In fact, I've shared with a lot of people that I've been in finance for a long time, 25 years in fact, and when this was first introduced to me, I had to look at this thing for a week, right, before the light bulb went off. So it is unique. It does take some extra time. I don't know how far down the rabbit hole you want me to go, so I'll stop there. And
what I think is helpful to people is comparing the features and benefits of this all-in-one loan that you've just described to what they're used to, the plain vanilla 30-year fixed amortizing loan. With the 30-year fixed amortizing loan, if you decide to make an extra principal payment of $10,000 for whatever reason, you might do that, your payment amount is exactly the same the following month. And you cannot get that $10,000 back out unless you apply and qualify and potentially pay fees. So therefore, in a lot of senses, the 30-year fixed amortizing plain vanilla loan is a one-way street. Once that money goes in, it's illiquid and it's difficult to get that back out of there. Over here with the all-in-one loan, you're telling us about its flexibility, about how you can basically deposit funds into it and go ahead and extract those out, basically borrowing against your home again in a small increment.
Absolutely. It's the difference between closed-ended, 30-year fixed, amortized, and open-ended, variable, revolving HELOC. So they couldn't be more different from one another. And a lot of people, I don't know if we want to get into this, but a lot of people hear that and they really start to get a little concerned about the variable part of what a HELOC will do, or any adjustable rate mortgage for that matter. And the way in which I try to frame and explain it, I've got a pretty decent example, and then I can do a little bit more deep dive. But take a 30-year fixed and a 15-year fixed. Okay, the amount of time that you have a mortgage really dictates how much interest you're going to pay. So the example that I use is a 30-year and a 15-year. Let's start with $400,000 as the starting loan amount. The 30-year has an interest rate of 4%, and the 15-year has an interest rate of 7%. Immediately, most people are going to say, I'm going to take the 30-year because at 4% versus 7%, when in fact, it's really the math that you need to be looking at. You're paying $40,000 more on that 30-year fixed than you would on the 15-year fixed at the significantly higher rate. So keep that in mind when people are thinking about adjustable rate mortgages. You've got to do the math.
Well, typically the 15-year fix would have the lower rate versus the 30, right?
Correct.
Okay. Well, to talk more about the all-in-one loan, okay, so we do have that potential risk of the ARM, the adjustable rate mortgage that one needs to consider. With an all-in-one loan being a lot like a first lien HELOC, typically with HELOCs, the borrower has the option of making interest-only payments if they choose to. Is that what's happening here with the all-in-one feature?
Yes, and this is where I think people get hung up. This is where I got hung up, because technically there's no payment due. Okay, you're simply depositing your income from all sources, and you're driving down the principal balance, and the interest cannot accrue the way it normally would. So let me say it this way. So let's say that you start with a line limit of $100,000, and you start with a balance of $50,000. There's no deposit due at all. You could simply let that thing ride if you chose to. That's not what it's intended to do. But in terms of payments being due, there isn't one. You could continue to let interest accrue, and that $50,000, zero deposits are being made, would just continue to increase because the interest accrual would go on top of that. The only time an actual payment is due is when the balance is about to exceed the limit. Does that make sense?
Ah, I see. Okay. So yes, that offers even more flexibility than what I thought, and even more flexibility than an interest-only loan where you need to make at least the interest payment monthly.
Yeah, it's pretty slick. I think that the clients, and it's actually very popular, the clients that we have secured this loan for, without exception, have all come back and been very, very happy with the decision. Now, I will comment that this is not for everybody. So the discretionary income is going to be important. So based on your income and your spending habits, if you have at least 10% left at the end of the month, that's typically what we find is where the all-in-one makes more sense, especially if you're comparing it to a 30-year fix, for example. If you're looking at the two side by side and trying to compare apples to apples, it'll tell you whether it makes more sense for this individual to go for the all-in-one versus a 30-year fixed. If you have $50 left at the end of every month, the all-in-one probably isn't going to be to your advantage. You're probably better served with a 30-year fix. So it's individual, and it depends on those variables, but more often than not, we find that the all-in-one is a very unique, very powerful tool for real estate investors.
Now, is the all-in-one loan, could that apply to one's primary residence as well as income properties? And then tell us about the interest rates.
Yeah, it absolutely can. It can go on a primary residence, a second home, or an investment property. Generally speaking, we want to advise the primary residence because you get a little bit higher leverage in that case, 80% to be specific. And also your primary is usually going to be the higher value. So your line limit is going to be higher and have more access on a primary. So all three are applicable. The interest rate is going to be, like we've discussed, variable. So there's two components there that we need to account for. There's a margin and an index. The margin is the fixed portion of those two components. The index is the variable part. That's the one that can move based on how that particular index moves. And the index for this loan is the 1-year average CMT. It's the Treasury. It used to be the LIBOR. That's been replaced with the 1-year average CMT because Brexit, LIBOR is phasing out. The margin on a non-owner occupied or investment property is 4%. The index still 2.04. So the fully indexed rate today for a non-owner occupied on the all-in-one is 6.04. Important to add that there are rate caps associated. There's a floor rate and a life cap. The floor rate on a non-owner is 4.75. So that means that no matter what happens, the interest accrual will never be less than 4.75. The life cap, the reverse to that statement, the max it can ever go, is 6% over the initial fully indexed rate. So if we were closing today, 6.04 plus 6, 12.04 would be the life cap in that case.
All right, so just to keep it real simple, the index plus the margin equals one's interest rate on the all-in-one loan.
Correct, called a fully indexed rate, exactly right.
Is there any last thing someone should know about the interest-only loan that you've been offering and helping people with there for years?
I am a big fan of both adjustable and interest-only, especially for real estate investors. If I'm going to try and statistically argue the points where people kind of get hung up on a 30-year fixed, I would share with them this. The shelf life of a 30-year fixed mortgage is between 5 and 7 years.
Right.
Usually the shorter end if it's an investment property. And the other thing to note is that the statistic historically says that the individual that starts on day one with a 30-year fixed mortgage and makes 360 payments later is less than 1%. So I try to educate people and have them look at it from a logical standpoint versus the emotional, psychological of that fixed rate, which is never going to come to fruition. So I'm a fan of the adjustable rates for those reasons when we're in a regular market. The interest only also for investors is just offering so much more flexibility. And in fact, one can actually pay off a mortgage faster, usually with an interest only, than they can with an amortized loan. Because remember, the amount of time that you're locked into that rate, the more interest you're going to end up paying. As an example, let's keep using the easy math of 100,000. If you're on a 30-year fixed loan and you started with 100,000, in 30 years, you're going to end up paying closer to 200,000. It's usually double what the initial principal is. So you could rapidly, if that's what you chose to do. I'm not a big supporter of paying off cheap mortgage debt that somebody else is paying for. But if you wanted to accelerate the payoff, you could do so quicker with an interest only than technically on a amortized fixed rate loan.
We're talking with Ridge Lending President and CEO Caeli Ridge. She's joining us from Tucson, Arizona, by the way. If you notice, her background looks somewhat different. We're hoping she doesn't get pricked by a saguaro cactus at any time during the chat here. As long as that doesn't happen, we're going to continue talking about mortgage loans in today's environment. And, you bring up a great point, Caeli. One thing that a lot of real estate investors and just lay people don't understand is, in a sense, you're paying a premium interest rate to get 30-year fixed certainty. Therefore, with an ARM, adjustable rate mortgage, you would therefore expect a discount, a lower interest rate. But of course, that does introduce the risk depending on, how long your interest rate stays fixed at the beginning of that ARM period and so on. But yeah, like you said, almost no one takes a 30-year fixed rate mortgage and they never refinance it and they never sell their property and take that all the way to term. 30 years, 360 payments, less than 1% of people. And, we've been talking about the term interest only a little bit. And sometimes I think that throws people off when we talk about, are you able to make an interest only payment on this or that? So if I can, just with a really simple example here, I had talked about this a few weeks ago. It really made some light bulbs go off in some people's heads. If you have, say, a $1,300 monthly mortgage payment, $300 each month goes toward the principal and $1,000 toward interest. Some people seem to think, with an interest-only loan, that's just a $1,300 payment that goes toward interest. No, that's not how it works. Just in general, what happens with an interest-only loan is you have the option of not paying the principal of $300, and you can only pay the interest of $1,000 if you so choose, but you still have the option of paying down principal at this level or even above this level. So it really enables people to think like an investor rather than a saver. And, some people are like, now, why would I ever do that? Well, what you've just done is if you cross this principal payment out and you don't make it, you just increased your cash flow by $300. You have not reduced your equity by $300. So really what you've just done is you've transferred your equity into cash flow. Well, congratulations. That's the financial freedom formula. You have the option with an interest-only loan. That's something that a lot of people don't get.
Yeah. And I would add to that too, and encourage people to kind of go online and find an amortization table. And on a 30-year fixed mortgage, what you're going to see is month by month, the amount of principal that is or the amount of your payment that's actually going to principal in the first 10 years of any 30-year fixed is is this much. You don't really even start paying the principal back until the later end of that loan. So that's another incentive to kind of going back to what we said. If we know that the shelf life of a mortgage is typically 5 to 7 years, and you know that the first 10 years of a 30-year fixed mortgage is 95, 99% interest, right? It really kind of helps build the case for the interest only.
Interest-only loans can make sense in some situations. They don't have all the advantages. For example, I paid 0.25% more in interest to have this interest-only payment flexibility above a like amortizing loan.
Mm-hmm. But the math again, so if you're looking at, let's say, 5.25% interest only versus 5% principal and interest, your payment is going to be less on the interest only and your cash flow will be better, obviously, on the interest only. The math. Remember, guys, do the math.
Do the math. Interest-only loans got a really bad name during the global financial crisis because for a lot of people, that's the only way that they could qualify for a property with the lower payment of an interest-only loan. So, of course, you, the individual investor, want to check and make sure that you're not getting in that same situation. And, interesting, Caeli, something that we've never talked about on the show before, another loan type that got a lot of people in trouble during the global financial crisis are negatively amortizing loans. Tell us what those are and if you think they'll ever become available again.
As far as I know, no. I don't expect to ever see those again in my lifetime. We didn't do them back in the day. We certainly wouldn't offer them again today. A Negam loan means that you're paying less than, so there were usually payment options, a 15-year, a 30-year, an interest only, and then I think it was the fully indexed below. And it would allow you to create a situation where the LTV, it's called Negam, it's like a start rate payment, where the balance would exceed the value of the home up to 115% in some case. So if you owed, for example, if the value of the property was 100,000, this Negam option could make it so that your minimum payments would actually increase the loan debt to 115,000. So you owe 115,000 on a property that's valued at 100,000. That's a problem, right? That's a Negam loan. Very dangerous type of financing and not something that I would recommend for anybody.
A Negam loan where your principal balance actually increases month after month. That's something that got a lot of people in trouble. Well, Caeli, you serve these all-in-one loans like you've described earlier, but of course you also do like a 30-year fixed amortizing loan, what we call a conventional loan for real estate investors. And when one does any of those loan types with you, what are the interest rate lock periods like?
So they get to choose. The longer the lock period, the higher the rate, but the options today are a 15-day, a 30-day, a 45-day, a 60-day, and we can even lock on a 90-day. The 90-day lock will be the 60-day rate plus a quarter. So they have that option for new construction or rehab or whatever if they're worried about volatility and interest rates. So all of those are available. Again, the longer the lock, the higher the rate, but as short as 15 and as long as 90.
Okay. With supply chain disruptions, that's something that some people are more concerned with. So it's good to hear that you have the flexibility for some pretty long interest rate locks and options that way. What if someone's interest rate lock expires?
More often than not, we can usually buy a few days for free and not charge the client. But once a lock expires, typically speaking, there are extension fees that are equal to 0.02% of the loan amount per day. So on $100,000, 0.02, $20 a day would be the extension fee for as many days as we need to extend.
Okay, so some real flexibility that way with the interest locks. Well, Caeli, you typically deal with investors that are buying properties out of the state that they live in. Oftentimes that's where the best deals are. Oftentimes those deals tend to be in the United States, Midwest and South, but there sure are some outlying areas too. And you offer loans in 46 states. So just tell us about that loan closing process, maybe for people that aren't familiar with buying across state lines.
And there's some people too that just have a comfort level of wanting their banker in their backyard, et cetera. But I'll share with your listeners that the chances that our client is either in the state that we're in or in the state that they're buying properties in is probably 1% or less, right? Very, very rare is that the case. We're very systemized and adept at handling all of the transactional ins and outs and setting up the notaries. And very, very rarely do we find that we're actually in contact physically with our clients and where they live and where the property is.
Yeah, now in the past, I've had a mobile notary, a human being that comes and either shows up at my home or shows up at my office, and we just do the closing right there, called a mobile notary.
Yeah, anywhere really. I mean, we've had people be on vacation in Hawaii with their family, and we arrange to have the mobile notary meet them at their resort, or I mean, really wherever, at the airport. We've had notaries actually head to an airport and meet clients there. So there's a whole lot of flexibility on making sure that signing piece, once the transaction is complete, it could really happen anywhere.
People must want an income property really bad if they're losing a portion of a day on Maui in order to get it done, but whatever it takes sometimes. So
Sure.
That's how easy it is to transact across state lines. Well, Caeli, you've done a great job of laying out the flexibility of this product called the All-in-One loan, where one could basically deposit money into it against their home and borrow it back out again if they choose to. And you also offer more conventional loans. Are there maybe any last loan types that you'll offer to investors that sometimes they aren't thinking about or that they don't know to ask about?
Sure. We're proud that we're not a one size fits all. We really do have a diverse offering of loan programs. So we've talked about the conventional, the all-in-one. Non-QM is a very diverse product line in and of itself, not just for investors. Anybody really that doesn't fit into one of the other boxes. Bank statement products, debt service coverage ratio, asset depletion. We have short-term bridge loans for fix and flip, or those that need renovation rehab dollars to finish an investment. Commercial products, which apply to commercial properties, obviously, which is anything over 4 units. But commercial, actually, some people are surprised to know that can actually apply to residential. It's called cross-collateralization. If you wanted to take 10 single-family residents and put them into one commercial blanket loan, that would apply there too. So pretty diverse mix there that we can offer our investors.
Yeah, see, and this is the planning that I discussed earlier, how they'll take a holistic look at your portfolio and really help you sequence these loans and consolidate things at times and really operate more efficiently as an investor. Well, Caeli, if someone wants to learn about the all-in-one loan or any of all these other mortgage product types that you have, I'd like you to tell them where they can find you, because Ridge Lending Group is where I have done my last few purchase loans for income property myself. It's where I've done my last few refinancings myself. So let them know where they can get started.
You can reach us in several different ways, everybody. You can go to our website, ridgelendinggroup.com. You can even apply online there. You can email us info@ridgelendinggroup.com, and you can certainly call us anytime, 855-747-4343. 855-74-RIDGE is the easy way to remember. And we look forward to speaking with each and every one of you.
Caeli, keep enjoying that sweet Southwest scenery there. Thanks so much for helping our listeners for so long like you have.
My pleasure, Keith.